On August 1st, 2012, a small software update triggered a $440 million disaster at Knight Capital, wiping out nearly its entire market capitalization in just 45 minutes. This catastrophic event was not the work of hackers or rogue traders, but rather the result of a forgotten piece of code. Knight Capital, once a titan on Wall Street, faced its darkest hour due to a failure in its software systems. In the bustling world of Wall Street, Knight Capital was a formidable force, executing millions of trades per day. Founded in 1995, the firm had grown into one of the largest trading houses, responsible for approximately 10% of all U.S. equity trading. The company's reliance on automated trading systems was both its strength and, ultimately, its Achilles heel. Automated trading allowed for rapid trade execution, capitalizing on minute market fluctuations. However, the same speed and efficiency that powered profits could also multiply errors at an unprecedented rate. The morning of August 1st started like any other, with a routine software update intended to enhance the firm's retail liquidity program. However, this update mistakenly reactivated an obsolete trading module, known internally as PowerPeg, which had been dormant since 2003. This obsolete module was supposed to be decommissioned, yet it resurfaced due to a deployment error, setting the stage for disaster. At 9:30 a.m., as the opening bell rang on the New York Stock Exchange, chaos erupted. The incorrect module began executing trades at an alarming rate, affecting 154 stocks. Each passing minute meant millions in potential losses. The PowerPeg module, originally designed to test the market by placing small orders and then canceling them, instead began flooding the market with real orders, buying and selling at irrational prices. The volume was staggering, over 4 million trades in less than an hour. Technicians and developers scrambled to identify the issue, but the complexity of the system and the speed of the trades made pinpointing the problem a Herculean task. The trading floor was a flurry of activity, with phones ringing off the hook and screens flashing red. Panic set in as the team realized the magnitude of the problem. Knight Capital's trading desks were left paralyzed, watching helplessly as the firm's future unraveled before their eyes. By 9:45 a.m., the realization hit. This was no ordinary glitch. The trading frenzy was indiscriminate and relentless. By 10:15 a.m., the losses had escalated to $440 million, shaking the foundations of Knight Capital. The firm's cash reserves were nearly depleted, and its ability to function as a market maker was in jeopardy. In the aftermath, the firm was left in financial ruin, its stock price plummeting by over 75%, confidence shattered. The incident revealed glaring oversights in Knight Capital's software development and testing practices. The reactivation of an outdated module was a testament to systemic issues within the company. There was a lack of rigorous testing protocols, and the oversight cost them dearly. It was a harsh lesson in the importance of comprehensive software testing and risk management. The absence of a rollout plan that included thorough testing and a rollback option proved catastrophic. The financial impact was immediate and severe. Knight Capital's market capitalization evaporated, leading to an emergency acquisition by rival firms. By August 6th, GetCo, a high-frequency trading firm, offered a lifeline by investing $400 million in exchange for a controlling stake, effectively saving Knight Capital from bankruptcy. Employees faced job losses, investors were left reeling, and the financial services landscape was irrevocably altered. Knight Capital, once a symbol of trading prowess, had become a cautionary tale of automation's double-edged sword. This catastrophe was a wake-up call for the industry. The event underscored the fragile balance between technology and finance, where a single line of code can lead to monumental losses. It highlighted the need for more stringent safeguards and the adoption of robust testing methodologies to prevent similar disasters. Regulators and market participants alike were forced to reevaluate their reliance on automated systems, calling for improvements in oversight and governance. Knight Capital's downfall serves as a stark reminder of the vulnerabilities in automated systems. The lessons gleaned from this incident resonate beyond finance, emphasizing the critical need for meticulous software management in high-stakes environments. The legacy of Knight Capital is one of tragedy, but also of learning, a testament to the far-reaching consequences of neglecting software quality assurance. In the years that followed, the financial industry saw an increased focus on risk management and system audits. Companies invested heavily in improving their software development life cycles, implementing more rigorous testing and monitoring processes. The Knight Capital debacle became a case study in business schools and compliance trainings, serving as a powerful example of what can go wrong when technology is not properly managed. Ultimately, the story of Knight Capital is not just about the loss of $440 million. It's about the human cost of technological failure. The stress and uncertainty faced by employees, the loss of trust among clients and investors, and the broader implications for the financial sector highlight the interconnectedness of modern markets. As technology continues to evolve, the lessons of Knight Capital remain as relevant as ever, reminding us of the critical importance of vigilance, foresight, and responsibility in the digital age.